Good morning, traders and investors. My name is Roger Scott, and I'm still the senior strategist for Wealth Press. Today is March 1st. Can you imagine it's March? I'm still like in the second week of January, okay? I don't know where February has gone. I'm still back in. If you told me it's 2020, I'd probably still believe you. At least like the stocks that we're looking at today, you'll see that they are reacting like it's 2020. But anyway, it's about 7:38 in the morning. If my screen looks a little bit different on the bottom, you know, I share my whole screen. I updated my Windows yesterday to the new Windows 11, whatever. I forgot what the version is, but it changes how your screen looks. But nothing has changed. No one has moved. Nothing has been changed. The cheese is still in the same spot. Anyway, the Nasdaq is up about 49 points. The Dow is up 63. I don't know if you guys noticed, but the last few sessions, actually the last couple of weeks, I've been carrying a very light load in terms of positions we've been holding. And that's because we've got so much uncertainty in the market. I mean, looking at the SPY right now, and I'll kind of give you an idea of what I'm talking about here. You'll see we're not having a really easy time getting up to that range back. It looks like we're kind of consolidating here. That's not happiness because earnings are behind us and there's no major catalysts right now on their way. In terms of economic data from the Fed, I mean, you've got PM manufacturing, ISM manufacturing, petroleum report, but nothing really crazy to drive the market higher. And earnings are pretty much behind us. Now, speaking of earnings, we still have some companies reporting today. You got Dollar Tree. You've got, let's see, Abercrombie. Let's see, Hilton. You've got Kohl's, Lowe's. That'll be interesting. Neo, Plug, Pure Storage. Let's see here, Wendy's, Snowflake, Salesforce. Oh boy, that's Salesforce. Don't get me started with Salesforce. I could talk about that one all day long. Anyhow, the bottom line is there's a lot of uncertainty right now. Not only is there a lot of uncertainty, it seems like we're having a period of consolidation and volatility levels are real low. So there's just not much action right now. And I don't want to put you in positions that are just doing nothing. It's just, what's the point? I'd rather protect you guys. And if you look at the QQQ, it looks slightly better maybe on a good day, but still, I mean, I'd love to see something higher. And most importantly, if you look at the Dow Jones, which you will see right here, it doesn't look like it wants to go higher. Notice it broke up a little bit higher, and then this bar and this bar are now lower. So there's just as much of a chance of us breaking down as us going higher, especially the longer we can stay or maintain at this level. So I'm really nervous about that, and I don't think the market's right now setting itself up for anything that special. Now, we could consolidate, but if you look at the bond market, you will see the bond market's also not really gearing up to go higher. And remember something really important. The stock market derives most of its value from the bond market. And if the bond market is losing directional bias, see that? There's a chance it impacts the stock market negatively as well. So again, there's a lot of uncertainty right now, and I don't want to be the guy that puts you into positions that are not doing well or doing anything just because. So we got to be really, really cautious right now. Seasonality is working right now. Patterns are working right now. Consolidated type of trades are working right now. Big pullbacks are not working because there's nothing to pull back from right now. So that's kind of what I just wanted to kind of give you the lay of the land. Notice something interesting, and this is very interesting. Remember, I always talk about sector fragmentation, and I always talk about how industrial and material and financial should be next to each other. These are fairly defensive sectors. Then you've got technology and communication services. And look at energy. It's like this does not belong here. This does not belong here at all. I'm going to make a prediction, okay? I'm going to make a prediction that technology, communication services, and consumer discretionary are going to become friends. And my prediction is they're going to come down here and maybe go a little lower, and energy is going to come higher. I was looking at energy today, and energy is sitting right at the 200-day moving average. But energy looks like it's consolidating, and I would find it very hard to believe that energy is done moving for the rest of the year. It just doesn't seem that way at all. I think, as a matter of fact, we're going to have more consolidation, more choppiness within the energy sector. I'm not 100% sure if we're done, but it doesn't look like we're going lower at this time. It looks like we're actually going to stay choppy. And there's a lot of stocks that are actually doing well within the energy sector. Let me just kind of show you. Even with this chop shop, let me show you this here. let's see here. I was just looking at them yesterday. You got Marathon. This is all-time highs. We're at 130, all-time highs of 136. You've got Quanta, natural gas stock. You've got here VLO. Again, not like it was a year ago, but there is some upside for energy. But I do believe energy is going to go higher. Now, let's take a look and see what's going on with the stock market today as abroad. So 3 U.S. major indices ending volatile February. It was a nasty February. On a down note, as investors feared that higher Federal Reserve interest rates would remain in place for longer to fight inflationary pressure. And folks, this is what I've been telling you. Norwegian, yes, I know a lot of you took a nice little juicy profit on Norwegian yesterday because of the VIP room trade that one of our members gave based on seasonality. And if you're in the VIP room today, I'm going to spend the entire time talking about seasonality. I'm actually having Matt run the scans right now as we speak. But Norwegian plunged 10%. They had bad earnings. It was a seasonality trade showing that the last 10 years, every day, over between yesterday and I think this weekend, it goes down. So we took that trade. It was a bonus trade. Some people made 150%. Anyway, they did well. And if you're in my VIP room, don't make sure you're there today because it'll be a juicy day. Meta climbed over 3% after the company created a new product to work with their AI product. The data today continues to show the Fed. Now, this is quotes from the Fed. I want you guys to read this. The data today continues to show that the Fed's job is very tough. Consumers are only just barely starting to rein in their spending. It's true, they are. We've seen it with the consumer spending. But they still see good strength in the labor market, Jeffrey says in a note. Chicago Fed President Austin Goolsbee Tuesday emphasized the need for the Fed to be data dependent and not rely too much on market reaction to guide policy. It is a danger and a mistake for policymakers to rely too heavily on market reactions that tell us which way the markets wants the Fed to move. On the earnings front, major companies like Salesforce, Lowe's, Snowflake, Neo, Dollar Tree are set to release their quarterly earnings today. So again, we have a lot of uncertainties because CRM, Lowe's, Snow, Neo, Dollar Tree, these are pretty good. They're not FANG stocks. They're not going to influence the market like FANG stocks, but they do have a lot of exposure. You've got U.S. manufacturing data coming out today. European stocks received positive handover from Asia after main indexes gained ground on signs of recovery in China's business activity. So China's not looking bad, and most importantly, we haven't heard the word COVID now in how long? A couple of months? That's very, very positive in my view. Very, very positive. Because the less we hear COVID, the less markets will move past that. We don't need another major catalyst like COVID ruining things for us right now. The Shanghai Composite closed at an 8-month high after data showed the country's composite PMI, a key indicator, expanded at the fastest pace in over a decade, rising to pre-COVID levels. At the same time, the Nikkei today lagged its Asian peers and closed slightly higher after data showed that the country's manufacturing PMI remained in contraction for February. So again, things are kind of choppy. Everybody's waiting to see what happens in the U.S. Now, as I mentioned, let's look at our sectors. I have very strong opinions on these sectors, but I kind of want to give you a broad view technically to show you where everything is. Financials look like they can still continue consolidating. They're holding up pretty well right now. They could go higher if the Fed data is better, if it continues to get better. But right now, I'm not so sure there's much upside ahead. Energy sector, I also believe, is choppy, and we're sitting at a fairly medium-term, not long-term, medium-term support level. Now, here's the problem with energy. If we break this level right here, we may be in a bad position. Actually, let me show you this chart. If we break this level right here, we may be in a bad position. But so far, we're holding up pretty well. And with the bond market being choppy, let's see here. Real choppy without much directional bias and without really pulling a slower, unless the data on the energy sector is really nasty, I think we're going to just kind of sit and chop around for some time. Industrial sector, very choppy, not a lot of action. Communication services, as I mentioned this to you guys, I told you, there's just not a lot of reprieve, and I'm not seeing a major catalyst right now taking us to the other side. Communication, consumer discretionary, same thing. We could get a little rise today, same thing with technology, but notice that communication services, technology, and consumer discretionary all look exactly the same way. They all look identical pretty much. I mean, there's very little difference between them. Be careful with consumer discretionary, but again, we probably are going to stay choppy because of the bond market. The bond market is looking really, really stable right now. Not stable in terms of moving in our direction. I mean stable in terms of liquidity. In terms of broad momentum, and I want to show you where the danger zone is right now. Everything is turning red. Now, look at how things looked and look at how they look now. Remember a few weeks ago when communication discretionary was at 80th percentile? Let me just show you this. 90th percentile, and I told you it's not going to hold. 50th percentile now. Remember I told you about information technology? 92nd percentile, 50th percentile, not holding. Meanwhile, energy, there's only 17% of stocks. So energy looks like it's bottoming out, which is why I'm, why I'm feeling like the worst may be behind us and why I'm starting to get a little bullish on energies. It looks like we're close to the bottom. It doesn't look to me like this. I'll tell you what I'm thinking. I'll be honest with you. What I think we're going to see is we're going to see a shakeout. We're going to see a little shakeout here, and then it's going to go higher. And that's because the momentum levels on the energies are already near the bottom. So I'm just not seeing all that much. I'm not seeing a major catalyst breaking down, taking us from 17 to negative. I think it may just go to 5 or something like that. But so far, only 17% of stocks are trading above the 50-day moving average. And that's not a bullish sign. That's actually a very, But the bottom line is it looks very defensive. Very, very defensive. Utilities, only 3% are trading above the 50-day moving average. Matter of fact, utilities have had it. Let me show you this here. See that? So I think utilities are actually one of the safer bets right now. Let me go back. I keep jumping back and forth. So my theory is utilities, energy, maybe consumer staples are going to start rising. Look at consumer staples. See that? But the offenders, the serial offenders, that the information technology, the consumer discretionary will fall by the wayside. In terms of the broad market, I got to tell you guys, here's the problem. Only 32% of stocks in the Dow are trading above the 50-day moving average. Only 48% are trading above the 200-day moving average. Nasdaq 150%, 52%. Things are just not looking all that great. And that's why right now what we need to do is we need to stick to the strongest stocks possible. Only the strongest stocks possible and the weakest stocks. So here's a pick for you. This is Avient Corp. Look at this stock. It's completely bucking the trend. Now, let's see what kind of stock it is. Chemical. All right, materials. I like that. It's not really, doesn't have a lot of exposure, and it's only 5 billion market cap, so it's not a huge stock. And look at this trend. That's a very, very nice, stable trend. Now, to the downside, you've got ADP. Yeah, with employment being wanky, I think ADP can come falling down right here. It's at support, but if we break down right here, we could really move in a very nasty way. So we got to be very cautious right now. Folks, now before I let you go, you got to be very cautious right now. Don't load up your positions. Let the market show its hand before we really get in hot and heavy. That's why I'm kind of low right now on positions. Now, I want to tell you something interesting. For the first time this year, my number one buy signal flashed my number one breakout stock. And that doesn't happen very often. So I'm going to go live today at 1 p.m. Eastern Time to reveal my number one breakout stock for the month of March. I'll also walk you through my number one buy signal and show you exactly how it works. Click on the link below. You don't want to miss out. It's going to be really cool stuff, and it's happening today, Wednesday, 1 p.m. Eastern Time. Do not miss out. I'll talk to you guys later, and have an amazing day.